Well, welcome everybody. How activist investing is reshaping in the boardroom. I'm David Faber, your moderator. Joining us is Gene Lee, the president and CEO of Darden Restaurants, Ray McGuire, global head of corporate investment banking at Citi, Cliff Robbins, the founder and CEO of Blue Harbour Group, and Sheehan, director of corporate governance at CalSTRS, and Jeffrey Smith, the founder, CEO, and CIO at Starboard Value. And let me start with you, if I might. Last year was a tough year for activism, performance-wise, even asset-wise to a certain extent. The assets stopped flowing in quite at the rate that they had been previously. You have investments. Actually, you're flanked by by the two gentlemen here who you at CalSTRS invest with. Do you question your investing in activism given the lack of performance last year?
No, we do not. We are still committed to this strategy. These two gentlemen are two of my managers. We've got a couple of other managers. We've got about $4 billion placed with activists. And really, David, CalSTRS is a long-term investor. We own the markets, about 189 billion assets under management, over half of that in the public markets, 2/3 of that passively indexed. So we're going to own the markets, and we're going to own it for a long time. So the reason we're committed to activism, because these two gentlemen and others like them, they really serve, in our view, a positive role for the capital markets. They serve as catalysts to help underperforming companies kind of right the ship, where they can improve the performance for the long term. So we're in the stocks that they get in before they get in, while they're in doing their agenda to accomplish that turnaround, and then we hold the stocks after they get out of the funds and move on to something else.
So you're not only an investor with them, but you will invest alongside them.
We have done co-investments alongside of them, but we're also invested alongside of them just in our index funds, but we will also do co-investments at times. And it really is the longer-term performance and the change that they do that is what has attracted us to the activists.
Well, how long have you been doing it? How long have you been? I mean, you guys have not, you've also been active as CalSTRS itself to a certain extent.
We are active owners with these 7,000 portfolio companies. We exercise our governance rights, we engage companies, we'll file shareholder proposals. We'll do a lot of our own activities in addition to the activist investing. We have been in the strategy a little over 10 years.
Okay, so the early days. Mm-hmm. And it sounds as though, do you think it's here to stay? Do you think that, the days are over where we would think that somehow this is going to crest and not be something that we're dealing with?
I think activism is here to stay. I think I'm not sure it's an asset class, but I think it's a strategy. You're always going to have some companies that could use a little catalyst to push them to improve their performance. So whether it's these two guys or funds like ours, or you look at like what BlackRock did with the case in Hong Kong with the gold company, pushing them to make some change. So I think some form of activism is here to stay.
Of course, these two guys are very different. I mean, Cliff, you approach things very differently than does Jeff. You're not going to get involved in a proxy fight. You're only going to embrace a management that, in a sense, embraces you.
That's true. I mean, everyone has a different strategy, and our strategy is unique in that regard. Before I started Blue Harbour 12 years ago, I had been 20 years in private equity, and I decided in our business we'd have a private equity approach to this public market investing. So we don't do proxy contests or get involved in litigation with our companies. I know Jeff doesn't prefer to do that either, but he'll do it. He'll speak for himself. It has done it, I guess, when it's needed. But our mantra is we only invest if the board and the CEO is on our page in terms of value creation, and we do it in a totally collaborative way.
Ray, has activism peaked in your opinion?
Well, it's not clear that it's peaked. Activism is just now called something different to how it's been called over the past 20-some-odd years. And I would caution not to get overly confused by the experience that these two gentlemen have generated in terms of returns and what the largest pension fund has generated. If you look from 2008 until 2016, the hedge fund index has underperformed the market. From that period, the S&P's return, let's call it 5.5%. The activist fund index has returned less than 1%. There is a group of investors out there, of which I think you're invested, of which there are probably 10 to 12 of them that have generated over that same period returns that are between 7 and 7.5%. That's a relatively small group of investors. Where we got seduced into the strategy was in 2012, when we saw the asset class, if you will, generate returns in excess of the market. It was the only year that that's happened, other than the select group. The assets under management went from 65 billion up 48% to about 90 billion. They went from 90 billion up to where they are today, which is about 100 and some odd billion. Over the same period of time, the number of firms calling themselves activist firms increased from 100 to 140. So while we may have generated returns with a select group, the overall hedge fund index has underperformed the market.
Well, Ann, if you're going about then determining who to choose from, and you've got a lot of people to choose from, and you seem to have had some success, what differentiates the winners from the losers, in your opinion? I mean, obviously performance, but what are you looking for to determine what you think that performance
ultimately
will be?
looking for performance. In terms of, we look at sort of the personnel, what their history is in terms of that, what their philosophy is, how they go about researching the company, what their thesis are in terms of the changes that they're seeking in the company. We probably spend, and I think both these gentlemen can tell you, at least a year, if not longer, doing due diligence on the managers that we hire in this strategy. We are very particular about who we hire because they're representing CalSTRS out there, and at times we'll go public with them on this. But it is personality, performance, philosophy, and how they put it all together.
So what is it about Jeff Smith? His personality?
I'll let Jeff, yeah, exactly. His personality. I'll add that other P to it in terms of that. But I think they do their homework. They have created shareholder value for us and for other shareholders in the companies. And Jeff can talk about a few of the examples, but they do their homework.
Yeah.
And they go in very focused, and they know how they can unlock some of that value if they need changes in the boardroom, if they need changes in capital allocation, whatever their strategy is, they do their homework. I think they got a lot of press attention to their Darden presentation that they did. I think a lot of discussion about the breadsticks. But if you read part of the other presentation, and I think Gene can tell you in terms of some of the improvements that they've done there, they've done well because they do their homework before they go in.
And Jeff, how's the Yahoo board treating you? That going well?
He's new.
It's been great.
Good. Well, I'm glad to hear that. We'll look forward to hearing more about it. Jeff, there are some criticisms of activism at this point that say the toolbox is empty. It's been about a rising equity market lifting all boats, to refer to a certain extent to what Ray was kind of talking about as well. And the day of buybacks or M&A or raising a rising dividend is that's it. That's all you guys have. That's not enough necessarily to really sustain creating long-term value when you're an activist. How do you respond to people who would conceivably level some of those criticisms?
Yeah, it's so we've been doing at Starboard. We've been investing in this way for 13, 14 years now. From our standpoint, it is not about capital structure improvements alone. It's actually more operational, and I think there has been some criticism that over the last several years, activism has appeared easier than maybe it really is. So from our standpoint, we're highly operational. You heard Ann mention that we do our homework. We do a lot of work around all the companies in which we invest. We're looking for companies where there's an opportunity to improve their business, an opportunity to improve their cash flow, and to see if we can improve it for the long term. How can the business be run better on the revenue side as well as on the cost side? I think that is timeless. Getting involved in companies that are performing poorly, that aren't being managed as well as they could be, and reinstituting disciplines to enable them to perform better is something that I believe will always be available. I think that as we moved, and Ray mentioned this, as we moved past 2008, there was an opportunity also on the balance sheet side to, you had companies that became overcapitalized because they were fearful of what had happened in 2008, rightfully so. And they were focusing, as they should have been, on producing more cash flow for their business because 2008 was really scary. So then when you got into 2009, 2010, 2011, you ended up with companies that had extra cash on their balance sheet and where stocks were pretty undervalued, where value could be created in an easier way by getting involved in those companies and asking them to do buybacks, to return cash to shareholders, to increase their dividends. And I think you did see a growth in investors who became more activist investors. I don't know if they were activist investors in their entirety, but where they were utilizing that tool set to push companies to do some capital structure changes, which did create value, and it became self-fulfilling, and then assets were raised for some of those investors as well as for investors that were more operationally focused. So I would say that the capital structure toolbox isn't always there. I would think the operational toolbox is.
Yeah. Well, I mean, you've had specifics, obviously, that you can share with us. Darden certainly was an important moment in activism, given when you took over the entire board.
Well, we didn't take over the board.
Yeah,
we
you
just
took it over. No,
we
you
changed
took
the board.
that board. You took it. I know. You replaced the
Shareholders.
board members at the will of the owners of the company. But then you had to actually get in there and do something. I mean, it's easy. Well, it's probably not that easy to write a 330-page report, which you did on Darden. Actually, how many pages was it?
I think it was 294.
Was that all?
297.
297. And then you and Gene go in there.
These two.
And I'm curious because it's somewhat unique to have a CEO and the activist together. How different is it when you're on the outside saying, well, you should do this or you should do that, and then actually getting inside Gene and saying, okay, this is where things stand, and he suddenly goes from, he's a board member now, and you're kind of working for him.
Yeah, the one unique thing about this whole transaction with Darden and Starboard was when Jeff showed up day one with a new board, he basically said, let's forget about what's in the 300-page deck, and let's learn together, and let's align on what the priorities need to be. We developed 3 strategic priorities within the first 30 days, and then we sat down and we put together a 5-year plan. And then we just focused on execution. And so Jeff never once brought up some of the things that he used in the proxy fight. He came in, he learned the business. We taught him the business. He would come to Orlando 1 day a week, and we would take him through, and we built it up. I remember one day sitting in our boardroom, taking him through the process. If we had 1 restaurant, what infrastructure would we need? If we had 10 restaurants, what infrastructure would we need? We went all the way to 850 restaurants, trying to teach Jeff about the infrastructure we needed to run the business. And so Jeff came along with us, learned the business, and we were able to really create some change. Let me tell you one thing that really helped me through this whole process. There's nothing like changing your whole board to have a mandate for change in an organization. Culturally, as an operator, culture is hard to change. But I never had a better mandate in my whole career to change a culture when the whole Darden board was changed out. Everybody was accepting of the change. They were looking up, what do we need to do to come back and regain the momentum? So that was the biggest gift I got through all this, was there was a mandate for change, and I could change the culture of the organization.
Jeff, how many of your expectations proved to be true once you got inside and saw what was really going on?
A lot of them. I mean, if we went through on a high level the amount of cash flow improvement, we actually exceeded the amount of cash flow improvement we expected in a shorter period of time. Did we get there with all of the same levers? No. I mean, as Gene mentioned, that really isn't the point. The point of the deck, when you come out with a deck and you go through a proxy contest, is to explain the art of the possible. That doesn't mean it's exactly what you want to do. As Gene mentioned, I never came in there and put down the book and said, do this. That's counterproductive. That doesn't make any sense. But we can talk about it and say, look, compared to your peers, Darden, you're not performing as well. So what can we do that would be better? Not just on the cost side, but also on the revenue side. And one of the benefits also, Gene's right, I mean, changing the board is an amazing thing. Look, I mean, I've been involved in boards in a minority capacity and a majority capacity and in now a whole change. It's incredible. I mean, it's if we could do it every time, it would be much easier. Doesn't mean we can do it every time. But one of the benefits also was the actual going through the process, which people don't realize. As you go through the process, you get to the end, you actually reach an annual meeting, you actually reach a vote. So not only did Gene have a mandate for change because you replaced the whole board, but there was a mandate for change because the shareholders chose to replace the whole board. And not only was that mandate there, but the employees inside the company had an opportunity to review this 297-page deck ahead of time. So I don't have to, and Gene doesn't have to, and Gene actually did, but I don't have to put down the book and say, you should do this. By the time I come in as a board member and the other board members come in, Gene has already shown the book to every one of the senior leaders. So the senior leaders are looking at it. If you're the head of supply chain, you've looked at the slides on supply chain. You know that someone's going to come in and ask you to improve supply chain. I don't have to ask you to look into it. You know that when you come into a meeting to meet with the board, you need to come up with answers about how supply chain is going to perform better, as an example. So we didn't have to do that. You already got past the however many phases of acceptance, and now you're able to come in and work as partners with the management team and just say, look, we're in this together. We all know we can perform better. Let's figure out how we can do a better job together. And it worked unbelievably well, obviously.
Yes.
I wanted to come back to your original comment and Ray's comment. I was thinking as I was sitting here about these 140 activists out there. And it just doesn't make any sense to me. It's hard to be an activist. I know Jeff would agree this, and I know Ann would too. It's hard to be an activist. You've got to have credibility in the boardroom. You have to have scale capital. You have to have investors like CalSTRS. You have to have the right team. It's not easy to do this. And that's why there may be 140 quote-unquote activists, there are only about 10 of us that have scale capital in the backing and the access to the boards. And the other thing I like to remind people, it's called activist investing. And the investing part is the most important part. You can have all the activism in the world you want, but if you don't have the right investment in the right company at the right price, you're really in trouble. So what this business really is about, and I know I can speak for Starboard in this regard as well as Blue Harbor, we are investors. We're trying to find a great company at a discount to intrinsic value, and then we bring the activist ideas on top of that. But it really starts with the investing. One of the advantages we have as activist investors, and this is really the dirty secret of activism, and I really think the key to why we have, and Starboard and a select others have been able to significantly beat all these indices over these years, is that we're not paying a premium. A private equity firm or a strategic buyer has to pay a 30 to 50% premium, and they buy the whole company. We're buying 5 or 10% of these companies, and we're paying no premium, but we have enough influence to impact their direction. And in the investment business, what you pay for something, such a prime return of your return, is a tremendous advantage that we have in being able to take meaningful stakes in companies and buy them at market. But my main message is it's really about the investing, not about the activism. You really got to make the right investment, and then you can bring your activist tools on top.
And you agree with that?
I do agree with that. And as I've worked with these gentlemen and others, that's why they take time in researching the companies and trying to figure out the right targets. A lot of them will take toeholds, build a position, do the research, and see if the thesis will play out. If not, they'll move on to the next one. But Cliff is right. It's about investing and looking at undervalued, underperforming assets that can be changed. And that really is, I think, the positive role that they play. I mean, if the companies were doing them themselves, there wouldn't be a need for these gentlemen. And what we tell companies and boards that we meet with, because I say we sort of own everything, is you should be your own activist. Look upon yourselves, do your own self-introspection. If an activist came at us, where are our vulnerabilities? What could we do differently? And I think one of the things that's going on in corporate America is that there are a lot of companies that are playing their own activist role, so that some of these two gentlemen or others will not go in and try and force some of the change from the outside.
Yeah, Ray, do you agree with that? I mean, when you're in the boardroom or you're advising a company, either on the prospect of an activist showing up or perhaps when one has, is it your sense that they've come a long way in terms of the learning curve?
With respect to this strategy, the answer is yes, unequivocally. There are incidents of where the board has created or conducted themselves and committed the cardinal sin. And the cardinal sin with this group of investors is not engaging. Right? Where you see no engagement, it is likely that the activity gets to be higher profile, described as being hostile, and described as being activist. Where you find active engagement, which is in many instances what occur in the boardroom, there is a conversation that's a constructive conversation. It's where the boards don't engage with the thoughtful analysis that at least these two firms have conducted. It's where they don't engage is where you run into incidents where the circumstances of the outcome it's not what the board would like for it to have been.
Jeff, you find that that's true in your experience? I mean, do you get more hostile if you're met with silence as opposed to engaged with, even if they're not necessarily in favor of what it is you're proposing?
I think it's certainly better to engage. I think that what happens often when we, now more than ever, when we get involved in a company, companies want to engage really fast. I mean, I think it's a combination of they've seen what we've been able to do when we get involved in companies, and so if they are really looking to do the right thing for the company, they do want to hear our views and see if they can work with us. On the one hand, on the other hand, I think they're more afraid of us than they've ever been. So both of those kind of work together, and we do get more engagement now than ever before. But I do think that the strategy for a management team should definitely be to engage. If they dig their heels in, shareholders don't like that. Whether it's us or any other shareholder, they really don't like it if management is unwilling to be open to change.
Mm-hmm. And the facts are, if you look at again the returns that you highlighted, the 5.5% return over that time period relative to the strategy, for the most part, it reflects boards having taken on their own action, that they've gone through and thought pretty carefully about their plans, which again have generated returns in excess of the strategy, other than, again, isolated incidents. So 500 to 600 basis points over the strategy would suggest that there's a lot of activity taking place at the board level, inside the boardroom, led by the leadership of the companies, the chief executives and their teams.
Well, I don't know what index you're using to come up with the comparison there. But I would say in general that boards are more open to being their own activists and trying to improve themselves from within.
So the index is the hedge fund research index versus the S&P? Okay, or if I look at a selected group of which you would be part, you've outperformed by 200 basis points over that same time period?
Well, I'm not going to talk about performance. That's not something we're supposed to talk about in public.
Oh, you can't talk about it? You can't talk about it. I love your diplomacy. The words you use are...
But if you're going to talk about the HFRI, I mean, you're linking together a lot of different strategies, including ones that are equity market neutral and long short and convertible arbitrage. But what I would say to your point here, Ray, is companies are attempting to work more proactively than I believe ever before. I think that's a good thing. There's been a whole cottage industry that's developed, whether it's banks or consultants coming in and pitching to companies that they will come in and they will provide an assessment to the company as to what an activist might say about your business from the outside in an effort to improve their results proactively. That's all very good, and to Ann's opening comments, that's what CalSTRS and other pension plans and other long-only investors, where the vast majority of their assets are in the market themselves, in the index. That's what they want. They want for the market participants, for companies to be more efficient, to operate better, to perform better. And I actually do believe that there's been some effect there, and you're mentioning that, Ray, from in the last, I guess you're mentioning the last 8 years. I do believe that the markets in general have performed better because of things like what Cliff and I and other activists have done to put more of a spotlight on companies, not just directly in terms of the companies in which we've been involved, but also very much indirectly, so that other companies who aren't performing as well as they should don't allow that poor performance to languish as long as they might otherwise have.
There definitely has been a sea change, and it's been palpable since the financial crisis in terms of the advances in corporate governance, and this is really helpful to activists because you can have all the great ideas in the world, but if you don't have access to the companies, no matter what your way of getting access is, it really would be unfortunate. And what I think that most people realize in corporate America that the root cause of the financial crisis itself was poor corporate oversight of Fannie Mae and Freddie Mac and some of the investment banks and some other institutions. And I think that began just a wake-up call, and directors became more aware of their responsibilities. Thought leaders like CalSTRS and others went to Washington and changed the rules on broker voting and proxy access. And it's just a palpable change today, and companies are willing to meet. And when they call their advisors like Ray and they say, I got a call from Jeff or Cliff or someone and they want to come talk to me, they're encouraged, and they do, get together and they want to hear. I'm generalizing, of course. There's always situations that isn't the case. But I do think this is a paradigm shift. I do not think we're going to go back to a world of no transparency, stockholders don't matter, the board being made up of the CEO's buddy from the golf club and the guy who owns a local bank in town. That is really over. And I think that this democratization of stockholder rights is a real change, and it's really why activist or active engagement strategies are here to stay, in my opinion.
And I would also add the shareholder community, the institutional investor community is much more active since the crisis. So it's not just the CalSTRS, but it's the BlackRocks and the State Streets and the T. Rowe's and the Vanguards who are stepping up, exercising their governance rights, exercising their ownership rights, and engaging with the companies. I mean, the incoming calls from us, it's just amazing. We don't have enough time in the day, especially during the middle of proxy season when people want to chat about some vote that they have. So what we tell companies is develop a relationship with your shareholders, because if you do have an activist and you disagree with their strategy, you need the support of your long-term shareholders to succeed. These gentlemen would not succeed if they didn't get the support of the shareholders. And there are others who are pushing for that change, throwing out the whole board. I mean, that was historic in terms of what they did at Darden. So the other advice we give to companies is get to know your shareholders and know what they're looking for, because that's who you ultimately need the support from. And there are a lot of large institutional shareholders who they want to support management as their default position, but these guys will succeed if they don't feel management has an answer to what the thesis is that they're presenting, or what they're doing to either change the operation, cut the cost, do different capital allocation. We have a saying in our office that bad capital allocation is the worst governance offense there is. So if they're wasting shareholder money, maybe they need someone like Jeff or Cliff to come in and catalyze that change inside the boardroom.
Right. Gene, though, I do wonder sometimes when I hear comments like that as to whether in this new world that we're creating, the CEOs are going to spend half their time just talking to their shareholders and not necessarily thinking that much about strategy or running the company. I mean, you can go down that road where they know it's good for them in terms of preserving their job, and they spend a lot of time doing it.
Well, I think the investor relations function going forward is going to be a big part of management. It's been somewhat subordinated down to a lower level director, senior director inside the organization. I see that role playing a much bigger role as we go forward. So it doesn't take up 25 or 30% of the CEO's time.
Yeah, but you know as well as I do, sometimes, do you want to talk to the investor relations person?
Initially.
How about you, Ann?
We'll start with them like Jeff, but we may work our way up if we don't get satisfaction.
But David, it's key for the investor relations to have the relationship with the right person inside the investment organization, especially with some of the passive money in the big houses today. But I think as a CEO, you've got to be very focused. After your quarterly call, you need to get out on the road, you need to talk to your investors, you need to let them know where you are, you need to tell them what's good, what's bad, and they have to believe that you're going to be transparent. I think that's the key to good investor relations. And then as you get further down the quarter, you remove yourself from the process and you wait for the quarter to end. And then you get right back out there and be transparent. I try to be out the following 2 weeks after I announce and try to meet with as many investors and make myself available to every one of my top 20 shareholders and say, do you want to talk? Most of the time they say no, but I make myself available and I try to get that all done within the first 2 weeks after announcing.
Mm-hmm. There are at least 4 lines of communication. We've talked about investor relations. I would say that there's the head of investor relations, there's the CFO, there's a CEO, and today, increasingly, the lead director has taken on a much more active role. So if you ask the audience that you as an investor would like to sit with. It's one of those four, and then as the conversation gets more intense, the lead director will take a much more active role in these conversations.
I mean, Ray's 100% right on that. We will not make any core position in our portfolio unless we have a relationship not only with the chief executive, but with either the lead director or the chairman. And it should be. I mean, the board is the one ultimately making these radical decisions that we're recommending about splitting the company up or making acquisitions or changing capital allocation policies. And while you need to have the CEO on board, you need to make sure that you have the consent and understanding and relationship with the board.
And it's
That's
also
very
the lead
important.
director when it comes to what is now the most active conversation, which is board representation. The lead director is the one that has to navigate between the board and whomever the investors are.
Right. Of course, when there's a fight, the lead director can also take the lead in fighting against them. I'm thinking DuPont, for example, Trian. They lost, actually, on Coleman. The lead director there, Cutler, was not. He was very active in opposing that.
Yeah, he and Ellen they spent time together out on the road. Exactly.
So it can come to being a very large
It can play an
opposing
important role.
Gene, what advice would you give? I mean, you had a unique experience in that you sort of came in, as you said, with this entirely new board behind you, so to speak. But what advice would you give to those who perhaps find a few board members replaced or in the midst of a proxy fight to a CEO who's in that situation?
Well, I think, first of all, recognize what is happening, and it's probably going to happen, and that you need to build relationships. And so in that first 60 days, I spent a lot of time trying to build relationships with not only Jeff, but the other 11 new directors, so that we could start building trust. I could understand what their point of views were. I had to, in this situation, I had to do some untraining. I used to always say, we're not in the proxy fight anymore. Some of the things that you guys talked about as you were putting this all together isn't the reality. And therefore, let's talk about what the facts are. One of the biggest things, I remember giving a little bit of a speech inside the boardroom early on to the new board saying, to move forward, we don't have to tear down the past. And I worked really hard with our new board saying, let's just focus on going forward. Whatever's happened has happened. Nothing's going to be gained by tearing down the past. And so I think build those relationships, build the trust. I personally invest a lot of time individually with every board member before the board meetings to ensure that they fully understand what's going on in the business. And when we get inside the boardroom for our 2 days, we can really be productive. So build relationships.
Jeff, what's it like to join a board where you've been fighting with them for a really long time? And one would imagine that there's a lot of mistrust and hostility as a result of what's taken place in the past and some of the things you've said and perhaps some of the things they've said.
Yeah, sir. In general, I'm not going to use the Darden example because it's exceptional and we changed the whole board. But in general, when you come on as a member of a board and you have to mix
There's
together,
one happening right now.
where there's one happening right now, it's much more collegial than anybody would expect. This is business. It's not personal. We, in particular at Starboard, work really hard. And if you look and analyze our comments and our statements about companies, we work hard to talk about what can be done better. Trying to use Gene's thoughts, tearing down the past isn't always helpful. So let's talk about what can be done differently going forward. And then when we get involved in companies, normally what happens, David, the first meeting, the first time we get together, those board members, they know that the company wasn't performing well. They aren't really proud of the performance. They know they've been missing their numbers for a while. We're not getting involved in companies that are performing well, right? These are companies that are performing poorly. So what happens in that very first meeting is I will tell you at least one, and usually most of the board members will come over and thank me for being involved, and they're happy that I'm there. And they want to assure me that they want what's best for the company and that they would be very happy to work together and figure out how we can do what's best for the business. And Yahoo's no different. Yahoo has been great. I mean, I said it, kind of tongue-in-cheek before, but the board members have been terrific and welcoming. The management team has been terrific and welcoming. And it's no different from almost all of the companies that we get involved with.
And Ray, I hear a lot about the distraction that a proxy fight can have for a company, and it's significant, as we know, when you get involved in one of these. What is your firsthand experience in terms of how you advise a management team that is not a believer in whatever is being proposed by the particular activist? Should they still seek to settle simply because the distraction and everything that else goes along with it is not worth a long fight? Or when should they fight?
You know, perhaps the most difficult thing for a board to decide is whether or not they want to engage in a proxy fight. That is, when it gets to that point, you've gotten to a level of discourse or dysfunction in communication. And boards would rather not get to that point. They would rather engage and engage even more in depth with the threat of a proxy contest. You don't have many boards out there who are in complete denial. Some are, but for the most part, boards are populated with thoughtful, experienced, well-resourced directors, for the most part, and management teams that they hold accountable. And to the extent you get to the point where there's a proxy contest and there's been a failure in communication of the strategy, there's been a disconnect between the management team and the board, and in many ways that results in a proxy contest where the outcome is going to be predicted long before the contest starts. The situation with Darden is somewhat unprecedented, where you have a complete change in the board and a complete change in management over a 12 to 18-month period. If you look over the past 20-plus years where that kind of outcome has occurred, the number of instances where that's occurred has been pretty small.
Yeah. You know, but Cliff, we're talking about sort of this new age of activism. It's here to stay. It's with us. Companies are more in touch with being their own activists, so to speak. So I wonder, do you think we'll therefore see fewer fights? Or will we see more, in part because the companies feel like we are in touch and we actually know what the broader base of shareholders really want?
I think over the long term, and I think one of the reasons, you know, as Ann said, why they're such big believers in activism is that over the long term, companies don't stop doing the right thing once the activist leaves, and other companies are going to introspect and catch on. And I do think that activism over the long term will lead to, you know, fewer opportunities for. I mean, this corporate governance change over the long term will lead to fewer options for activists over the long term. But one of the things I really like about our strategy is there's thousands of companies to choose from, and we're only investing in 10 companies. I think Jeff's only investing in 10 companies. So while all this activism is going to help corporate America introspect and do things themselves, there's still going to be plenty of opportunities for activists to...
Yeah, then why do we get follow-on activists? I mean, I can name a couple. Mondelez, Yahoo, I can name a bunch. If there's so many companies out there, why in the world are you guys seemingly picking on the same ones?
I don't know. I can only, for Blue Harbor, you know, we don't invest with other activists, and we don't invest in other situations where other activists are there. You know, activists come in different sizes and shapes. There's been a big movement towards large cap activism, which we don't do, and nor the hostile activism. I have felt that the mid-cap space and the 2 to 10 billion, which is where you don't see as much overlap with other activists, has been what we've done. I think that's a particularly sweet spot because the companies themselves tend not to have the resources to come up with a lot of ideas. A typical $3 or $4 or $5 billion market cap company doesn't have its own tax department, doesn't have its own corporate development department, doesn't have millions of dollars, that McKinsey on retainer, tends to be more ripe for new ideas. And then there's also M&A, of course, where those companies are more apt to participate in M&A. So in our world, we tend to not invest with other activists, perhaps because the market caps we're in are such that that hasn't attracted other people.
Right. Although that's shifted, right? We've shifting now in this environment from large cap to, which I would say is $10 billion plus, to the smaller mid caps, where you see a overpreponderance of the activity taking place with companies whose market values are $1 billion and less. So you have the, let's call it $10 billion and under, even $5 billion and under, where you see most of the activity taking place with this strategy. Mm-hmm. And with respect to proxy contests, you'll see a precipitous reduction in the percentage of proxy contests that have been launched over the past 18 to 24 months.
I mean, I'm not involved in proxy contests. As I said, we've never done them, we won't, but I have observed I thought it was very interesting how quickly Johnny got seats at Conagra, how quickly seats were given at United Airlines very recently. I think companies don't want to fight.
Companies don't want to fight, and I think you're going to find the facts support many more instances where there is the addition of a board member or two as a result of these conversations versus an outright proxy contest. The number of proxy contests, as I said, I think you're going to see fewer and fewer of those because boards understand that the strategy is got substance behind it. Apart from the theater that gets reported, there's real substance behind a lot of the thinking that is taking place with the investors, and that translates into boards being open to one or two new members who may have a different thought process.
I want to open it up for questions from the audience. If people want to raise their hands, we can throw a mic over to them. And while you're thinking about a question, I'll come to that in a second. And when you are making a decision as CalSTRS, and you're involved in a proxy fight, or you're an owner, how are you going about making that decision?
Well, when we're involved in a proxy contest and it's someone, maybe not one of these two managers.
No, I'm saying,
'cause
right,
we own
another
everything.
portfolio
Yeah,
company to
we
do that.
sit down with both sides and listen to what their thesis is. And we sometimes end up supporting part of the activist slate. Sometimes we'll support management. But we'll see, and we'll see how management responds to what the thesis is that the activist is bringing forward and if it makes sense and if there is some need for the change. A lot of times there is need for some fresh blood in the boardroom. And I think that's one of the reasons that you're seeing some of these settling, some new skill sets inside the boardroom. But we'll weigh both sides before we make a decision on
how
to
often,
vote.
I mean, I don't know if you track it or not, but how often are you coming down in favor of that?
Probably, I'd say 50-50 maybe.
Oh, really?
We don't track it, yeah. A lot of times we'll support maybe one of the directors from the activist side. But we've ended up on both sides. Sometimes we've supported management flat out on a proxy contest. So
Right.
it just depends on the case. We haven't had that many of late. I think that's what was said before.
Yeah.
I think more of them are settling, and they're listening to the activists when they come in. And we encourage that. Sit down and listen to them. Don't just circle the wagons and fight them off. Listen to what they're saying.
Do we have a question? Yeah, I see a gentleman. Actually, I'll go to this gentleman here, and then we'll get to you.
This is a question for Jeff and perhaps Ann as well. If getting that shareholder vote, that mandate when you arrive is so powerful, then why settle? Why not push it and get that mandate that you spoke about earlier?
Jeff, you want to?
It's a tough debate. Look, a proxy contest is time-consuming. It's expensive. It's distracting. But there are benefits in getting a mandate and having the shareholder base give their clear thought to management and the board. From our standpoint, if we can accomplish what we want inside the boardroom and work with management and the board sooner and get to work, we would much prefer that and take away the cost and the wasted time. But there's, if we're talking to a company and they haven't really accepted that change is needed, if they're just going to, be willing to hand over a seat, 2 seats, or whatever it is, but they really aren't accepting of change, then you may be better off continuing so that they can see that the shareholders really do want change.
Yes, the gentleman in the center there.
How concerned is the panel about directors' remuneration? Is that an issue that draws your attention?
I don't know who wants to handle that, and I think,
Director.
and part of you talking about the fact that activists may pay their nominees differently than the rest of the board, even when they win, or when they win. Is that what you're?
Yeah.
How do you feel about
this-
that? Because it came up in a
It
number
came
of
up
instances.
in the
Came up in
Canadian,
when
and
Harry
Jana and
was doing it.
Agrium, I
Came up
think,
in
yeah.
Jana. Also, Loeb did it with
Yeah.
I
I think the issue is
Dow.
the shareholder community wants disclosure about what those relationships are. I know a couple of companies tried to, after the Agrium situation, and a couple of them tried to sort of preemptively adopt bylaws that prevented those types of things, and the shareholders kind of revolted on that. So I think the issue there is transparency and disclosure. tell us what the deal is that you have with this person. I think that some of the shareholders have revolted against some sort of performance incentive. They'd rather say, okay, it's a flat dollar amount. And we're not seeing those types of arrangements. It kind of died down after those incidents a couple of years ago.
Jeff, I'm curious, what are your thoughts about a board where, and again, it isn't prevalent, but it was something we saw, where a board has certain members who are being incented and compensated differently than others. Is that okay, or does that create some dissension?
There's always different interests of board members, in that board members that have been there longer usually own more stock. Board members that have taken money out of their pocket to buy stock own more stock than other board members, so they do have different interests. So I think some investors have taken that to another level and said, well, if we give them the ability to own stock on our behalf, that's not any different than a board member that owns more stock. From our standpoint, we compensate our board nominees with a small amount of dollars that they need to use to buy stock. There's no ongoing relationship at all between us and those board members. We believe that once they get in the boardroom, they should just be stockholders and representatives of all the shareholders.
There's a different issue, though, that I think needs to be fixed over time, and it's not the issue of disparate compensation to directors. It's the fact that directors generally do not own a lot of stock in companies today. So we figured out how to fix the management piece. It's very important for us at Blue Harbor that management have skin in the game, and we've gone to the comp committees. We've gotten plans changed to make sure our management has performance and TSR-related option and stock programs, and we've got the change of control all figured out. So we think we're aligned with the management teams, which is important. But the board in most companies do not own a lot of stock, and that's a problem. And over time, that will need to be addressed, either by making compensation for the board all stock and no cash. These are things that ultimately I think would be good. And we love when we find it. It's hard to find. We love to find a situation where there's a founder or a large stockholder on the board who has a significant stake in the business, independent from the management team, because people generally do make decisions in accordance with their personal self-interest. And I think directors not owning a lot of stock is one of the things that needs to be changed over time.
And
we've made some progress. We've made some progress here. Boards have made some progress. Sorry, Ann. So boards have made some progress here. It's not perfect, but the holding period requirements are, and the holding amount requirements are very helpful. Unfortunately, usually they're set at a level where you can earn your way into it, so they're still not requiring board members to take money out of their pocket in order to reach their thresholds. But one of the key components of that, which really has been very helpful, is restricting board members' ability to sell stock. One of the things that really has bothered us as shareholders is when you see board members, management's a different story, but when you see board members that are selling shares of stock as board members, that's just it's a terrible sign. It's a terrible practice. So we're actually in favor of, when we get involved in companies, of making it that board members actually don't receive their shares until they leave the board. And until then, it's really more phantom stock that accrues. And then in order for them to have any ability to sell their stock, they actually have to leave the board.
I would say, yeah, the shareholders are paying much more attention to this issue because we want the directors to be aligned with the long-term shareholders, and having that equity ownership really helps align that. And as Jeff said, it's troubling when we see a director sell. It's like, okay, what's going on? Is this sort of an early indicator of something that's happening? And I think you're hearing more shareholders talk, when they do engagements with the company, talk to them about what the directors' requirements are.
Right.
Yeah, and David, as a CEO, I would support that. I like to see my board members all own a lot more stock than they do today, but it's a tough sell, and we've been trying from day one to push that. As CEO, I want to have everybody sitting around me have a lot more skin in the game.
Yeah, it's not a corporate governance panel, but I think there's a question, though, as well about whether or not, you can find qualified board members these days. Now, you guys want them to own stock, so they have to have some sort of net worth to do that or some ability to do that. They could end themselves up in a proxy fight. They could be on a comp committee or who knows, or an audit committee that could have numerous meetings. Is it still, can you still find qualified directors given all the challenges that may be out there?
I would say yes, there are plenty of qualified directors and diverse directors, directors with different background. Look at some of the C-suite people in companies that maybe can have one other board. There are plenty of qualified directors. And I think that equity ownership interest from the shareholders' perspective, it better aligns with us. And in terms of what some companies have done is, you know, they pay them in cash and then have them buy the stock with that and build up an ownership holding over a number of years. Because if you're a long-standing board member, you may have quite a bit more stock than someone else. But encourage them through their payment to invest in the company, because it's a huge signal to the shareholders that they have trust in that company and they're going to put their money right alongside those of us who are the outside shareholders.
Do we have more questions from the audience? There's one over there, yeah. I'm sorry, we'll get you next.
There are a couple of examples of companies that have, I think by most people's standards, have underperformed and yet have not been targeted by activists. And most of these companies have Warren Buffett as an owner, as a partial owner. Is there an unwritten rule among activists that Buffett-owned companies cannot be targeted?
Cliff?
Well,
Another Buffett rule, is it out there?
I'm investing in the $2 to $10 billion market cap range, so most of those companies you mentioned are not in his purview. But if he was an investor in a company that we thought was undervalued, we'd be thrilled to invest in that company.
But Jeff, does he tend to protect management if you want to get in? And I can think of an example, for example, American Express, where Value Act was in there and then they were gone. IBM obviously also comes to mind. I don't want to put words in your mouth, sir. I mean, would you consider going after a Buffett-owned company?
Hey, look, from our standpoint, it's about value, plan, and path. So the company has to be undervalued, there has to be a plan to unlock that value, and there has to be a path to be able to implement the plan in the event management is unwilling to work with you. It would depend. So this is a path question, meaning is Buffett or Berkshire going to be able to get in the way of us being able to convince shareholders to support change? If he doesn't own enough stock to influence, or if the halo effect isn't going to be enough to change things, and there's enough value and there's enough of a plan, then it's certainly not off the table. But I would also think that if we had a great plan and it was in the best interest of all shareholders, including Mr. Buffett, that he would be in favor of endorsing such a plan or working with us or working with management to make those changes.
But let me throw out one company that I would defer to these two in terms of investing. But the executive comp discussion a couple of years ago at Coca-Cola, he's a big owner. He had a big change in helping change that structure. So while he may not do it publicly, but he did work behind the scenes after that activist took on the comp structure at Coke. So I do think he does think about these issues from a shareholder perspective. And I think his discussions behind the scenes on the compensation, we saw a huge improvement that following year in terms of their comp structure.
Good.
Yes, let's get to this gentleman here. If we can get a mic to you. 1 second.
Thank you. We've recently started to see a few more activist campaigns outside of the United States, specifically in Asia. I'm interested to hear how activists think differently about mounting a campaign outside the U.S. And also from Ray, if you would be advising a client differently, if it's a non-U.S. client or if it's sort of the same across the board.
Right.
Yeah, Ray.
So in 2015, there were 340 or so campaigns, 40 of which took place outside of North America. Then you have to go through and segment the geographies. Europe, none of these geographies are monoliths, so Europe and in UK, for example, or Germany have a completely different governance structure, more difficult for activists to mount campaigns. Japan, you've seen some success, which is culturally a shift in the whole Japanese market. You've seen some changes in other parts of Asia. In Hong Kong, you've seen some changes. And we've seen some changes as a result of the investor activity in Korea. We've seen a lot fewer this year. Of the 50-some-odd campaigns this year, I would say 5 to 6 or 7 of them have been outside of North America. Having said that, In the geographies where there's a change in the overall governance structure, like Japan and like some parts of Asia, some of the activists have sought to make investments there, and they've been somewhat successful. I would say Europe, for the most part, I would take out of that, just given the overall governance structure. But in Asia, Pacific, from Australia, from north to south, I think going to see more activity.
There's another question I can take in a second as we're wrapping up here. Jeff, we talked, or Ann mentioned earlier, or actually I think, sorry, it was Cliff, about making the right investment. What about when you make the wrong investment? And I've, on TV, given you a hard time about Macy's. You know, it hasn't gone well. You came in with a thesis, and I think management at least was, and I don't know specifically, but they seemingly engaged with you to a certain extent. When do you say, okay, this is just not going to work? You're still in that stock as far as I'm aware.
Look, it's about value, plan, and path for us. And as Cliff mentioned, getting the value right is a big portion of what you do. So I would still say that our plan as it relates to Macy's is an excellent plan as it relates to improving the operations of the business, taking costs out of the business. They've announced they're going to take several $100 million of costs out of the business after having discussions with them. And looking to monetize the real estate, which, again, we valued about $20 billion, which is roughly the enterprise value of the business. The enterprise value is less than where it was when we first discussed the idea. You know, getting the value right and the timing right is a big portion of what we do. And, you know, in the case of Macy's, we entered earlier than we should have. We missed the seasonality of the unbelievably warm winter. It affected all retailers, not just Macy's. And they, you know, had a big effect from the weakness in oil-denominated currency on their tourism business. You know, sometimes you don't get the timing right. That doesn't mean you can't fix the business and the operations of the business, and you rebuy your portfolio every day. So it's not about whether you're looking to move on because you didn't buy right. It's about what do you do from here? What's the right answer from here? Is it still a good investment from here? Is there still something that can be done that's different from what management's doing? And can you still be effective in order to implement those changes?
And what about when you want to harvest the winners, as in Darden? I think you sold 40% of the stake some time back. You still own a significant stake. But, you know, when do you make that decision, especially given the influence you've had on the company and the board?
Yeah, exiting positions is hard, but we have to, you know, stick to our discipline. From our standpoint, what we look for isn't so much whether it's fully valued. We're not looking to top tick anything and sell out because a stock is worth more than it should be. We're looking to move out of positions because it's not something where we can implement more changes to the company ourselves. We can't control the alpha as much anymore. It's more of an execution story. So in the Darden situation, you know, it's a world-class management team. Gene is an unbelievable CEO and has done a fantastic job with the management team, and the board is outstanding. And, you know, when I'm able to sit in the boardroom and just smile because everybody's doing the right things, it's a pleasure. It's terrific.
So is that time to go?
But that's when it's time to go. That's when and you know, Gene and I had that conversation. That's when it's time to go. And Gene and I sat down and I said, you know, you don't really need me anymore. And he kind of said, yeah, I know. So that's when it's time to go and let the company graduate and move on its own and do the great job that they're going to do to continue to execute and continue to follow the 5-year plan and continue their long-term planning and accelerate the progress. That's a pleasure for us. We love to see companies that perform really well, not just when we're involved, but after we leave.
Do we have any other questions from the audience before we wrap up? Cliff, did you want to add anything in terms of exits? I know obviously it's a different discipline for you, and you're looking for an M&A opportunity sometimes, but
yeah, I
when is it time? I mean,
selling is a skill set. I mean, it's a very important skill set. And, you know, for Blue Harbor, you know, we've been fortunate because we do invest with this private equity lens and we underwrite that each of our companies have strategic value. 1 in 3 of every company we've bought has been acquired. So that's been an exit 1 in 3. With the other 2 times out of 3, we have to sell. And I have not yet met the CEO who wants to get that call from me or one of my partners. Say, hey, by the way, we own 5 to 10% of your company and we're going to sell. But we make those calls regularly and We have to sell when the risk reward is no longer in our favor. When, as Jeff said, we're no longer have a new active idea. Our clients don't pay us to be passive owners in companies. And the third is, it's often because we got something else we want to invest in that's better, something else with a better risk return than where that eighth inning investment is. So we need to sell, and selling is a discipline very, very important.
All right. Well, I want to thank everybody, of course, our panelists, Jeff and Cliff, Ray and Jean. Thank you all, and thank you.